The rate reductions are finally coming. We've seen our first one in September, another one followed in November, and we could see a third rate reduction in December of this year. And what does that mean for your finances? When we start looking at a lot of savings rates, CD rates, even high yield savings, a lot of those rates are slowly disappearing as the Fed continues to reduce rates. Now, of course, in an interest rate reducing or falling environment, it does make money cheaper for companies, but it also really puts people like myself that want to save money into a pinch. So in today's video, we're going to be looking at the 8 best places to put your money as rates continue to fall. Now, overall, with the rate reductions, we could see it into 2025, into 2026. We don't know exactly how low or how frequently they're going to drop them, but it will have a big impact on your finances. Now, the first one we look at, and this is one that I've done a lot being a financial center manager, longer term CDs. So a lot of institutions have like a 9-month, an 8-month, and then they have a longer term, an 18-month, a 24-month. A lot of people are starting to put money into those longer term CDs because essentially what they're looking at and what the forecast is in 18 months, in 24 months, rates are going to be significantly lower than what we're seeing today, meaning when that CD comes due in 18 months, the rates are going to be considerably lower than where they are today. Now, by locking in today's rates for 18 months, for 24 months, for any tier or longer CD, you can really lock in the benefit of having that higher interest rate, where even right now we have 9-month CDs that are around 4.8%, and we do have some 18-month CDs that are around 4.6. So still seeing a very high interest rate when it comes to not only the short-term CDs, but also those longer-term CDs. Now, with CDs, you know they are FDIC insured or NCUA insured, depending where you're keeping them. And that gives a lot of people during retirement a peace of mind and a steady ability to get income. Now, when we talk about very steady, the tried and true, a lot of money moving out of the financial institutions and going into Series I bonds. Now, Series I bonds, they do keep pace with inflation, and it is really good to have these bonds. Now, you are limited to how many bonds you can buy, but overall, it really pays 2 types of interest. One is a fixed interest that remains in place for the entire life of the bond. The second one is the inflation adjusted rate, which can change every 6 months. So again, when you think of the bond, you're guaranteed that fixed rate, but you could also see a bump depending on where inflation goes and also depending how long you hold these. Because remember, these are issued and you can get interest for these for 30 years. So a couple years back when interest really peaked at around 8.2%, you were not only getting that inflation adjusted rate, but you were also getting another higher rate on the fixed rate, which made the I bonds really highly sought after. But of course, a lot of people didn't realize 2 things. One, you were limited to how much you could buy. And 2, you could also, at some point, not only could you only buy a certain amount, is you had to hold them for a certain amount of time. That was the second part that a lot of people didn't realize. Now, staying on the same side, they do have TIPS. Now, TIPS is Treasury Inflation Protected Securities, or TIPS. This is another one that is a built-in inflation protection component. Now, when we think of Warren Buffett, he put a ton of money into government bonds. When you start looking at most Treasury securities, they pay interest, but unlike Treasury securities, the principal adjusts for inflation. Again, meaning if inflation does increase, we know it's going down right now, but it doesn't really, we don't know how fast it's going to and how far down it's really going to fall. Now, other types of bonds, you could look at corporate bonds, you could look at municipal bonds, you could look at a lot of different bonds. And of course, if you're buying the bond now, it is going to hold up for later, but the value of the bond as rates go down, the value of the bonds do decrease as new bonds are issued because they're issued at lower rates, which is the reason why a lot of people want to lock in those longer term bonds today, knowing again that inflation rate is going to be coming down in the near future, or those rates, the Fed fund rate is going to be coming down in the near future. Now, if you want to get out of bonds and you want to get into something a little bit riskier, peer-to-peer lending, when you think of Prosper, when you think of Upstart, there's a lot of institutions that do peer-to-peer lender. Instead of just having the money parked in the savings account, you can actually lend it out to individuals that need cash. In return, you get a higher loan rate depending on the risk that you're willing to take. You could only lend to certain people with certain credit scores, or you could take a lot more risk and lend to that, essentially the E, the D, the C, the lower credit rating. But of course, you could lose money if the borrower that you're lending money to does default. So you have to be very cautious of that. And a lot of them, like Prosper, Upstart, they're the guaranteed personal loans. A lot of times when I see loans outside of, regular financial institutions like your Chase, your Bank of America, or even your credit unions, it is through Prosper, it is through Upstart. It is at a very, very high rate. And usually it is an absorbent amount. I've seen some loans from Upstart that are upwards of like $30,000, but they're at a rate of 30%, which is insane. When you think of that amount of money at that rate, that is a really, really big investment. Now, of course, you could get out of lending in general and go right into investment real estate. Now, of course, a lot of people do pull money out of a savings account, find a place to put it. Purchasing real estate has always been historically a very good place to put it, especially if you're looking to get not only the rental income, but now again, as we're getting into that lower interest rate, if you do have to borrow money, if you do have to get a mortgage, the rates right now are a lot lower, meaning that every $1,000 you put in there, you could see passive income coming in when you're buying a property or when you're having that investment real estate. And essentially the person who's investing it or the person who is renting it out is paying for the house and building the equity in that home that you can use for future use. If you buy it or if you end up selling it, if you end up doing anything else with it, it can produce a very steady stream of income, which is the same with side hustles. Sometimes you've got to spend a little bit more money to make a little bit more money. And this is where it comes to, again, just the general thesis of investing in yourself. The time and effort in really looking at a side hustle, you could do something like I do here on YouTube. And of course, if you like the content that I'm putting out, definitely subscribe to the channel. But when you start looking at, people going for Pokemon cards, going to yard sales, going to thrift stores, going to estate sales, flipping things online with Facebook Marketplace, there are so many different ways and so many things that you can pick up that are a profitable side hustle. And of course, the one that we're seeing more than anything right now is moving the money from those savings accounts, those CDs, those high yield savings accounts, and moving them into the stock market. Interest rates, as they do climb in recent years, a lot of people really wanted to trim the exposure to stocks. But after all, where you can get 5% in a savings account, where you can get 5.5% in a CD, which is an ultra safe option because again, they are insured. Why would you keep it in the stock market? Well, now's the point where the CDs are starting to go away. High yield savings accounts are doing the same. So a lot of people are moving it into cash or moving it right back into the stock market because that is the place where we are seeing the growth. When we start thinking of the better returns, when we start thinking about the S&P 500, index funds itself are yielding about 10 to 12% over the last 10 years, which is incredible. Now, a lot of people think they're kind of high risk, and I know there is a risk associated with it. If you're buying individual stocks, you could see a much higher risk factor in there. But overall, buying ETFs, and especially if the market does see a little bit of a decline or a correction, 20, 30%, I would absolutely love. It would give me the ability to actually buy the stock market at a much discounted price, meaning that every dollar you're putting in would buy essentially 20% more if we did see that 20% reduction in the stock market. Now, I know most people don't like to see their portfolio and the balance of that portfolio go down, but there is no point in history that the market is going to go up forever. We need those correction years. We need those years where you're buying it with your 401k, when your investment portfolio, with everything else where you're buying it at a discounted price, it really does make a big difference. All right, guys, so that is 8 of the places and the best places to park your money as we're continuing to see these rates fall. And of course, as we continue to see rates fall, especially when it comes to the market, we do see a lot of companies, as money gets cheaper to borrow, they see a lot of ability and really the ability to fund projects. When we think of AI, when we think of upgrades, when we think of, outdated technology being essentially revamped, replaced in smaller companies, even looking at the small caps and the mid caps, there is a big runway for those once money does get a little bit cheaper. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.